Hello, I hope you are doing well today. Welcome to our lesson 2. In our previous lesson, we learned about the key roles and functions of a finance manager in a business. Therefore, in this lesson, we will talk of sources of company finance. I believe you understand the term source, also company and finance, which means funds or money. Therefore, companies have different alternatives for obtaining funds that is used to finance investment project. The company can issue debt or equity securities to archive this goal. Particularly, when we talk of securities, we simply mean financial instruments that represent an ownership position, a creditor relationship, or rights to ownership. They include stocks, government bonds, and more. To this end, this lesson discusses the different sources of finance, including their advantages and disadvantages. As you can see, the image contains the text lease. Lease is among sources of finance, and am particularly sure you have heard of the term being mentioned, or your family has engaged in leasing activity, or even yourself have done it. Let me give you an example based on what I have seen. A person wants to use a car but does not want to buy it outright. They enter into a lease agreement with a car lessor, agreeing to pay $400 per month for 32 months to use the car. At the end of the lease term, the lessee may have the option to buy, return the car to the dealer, buy the car at a predetermined price, extend the lease under new terms. You get it? That is just one scenario of how lease happens. Before we look at the more sources of company finance, let's look at ways in which a company raises finance. A company can raise finance in the following ways. A. From finance classified according to the relationship with the part giving the finance. Examples of finance raised under this classification includes A. Equity finance, B. Quasi-equity, C. BEPT. Finance. I just remembered most of my classmates in the high school I studied in were unable to pronounce the word quasi correctly, but guess what? Likewise, I experienced difficulties in pronouncing, but amazingly, I was the better one. Now, equity, quasi, and debt aren't the same, and maybe let's just look at what each of them refers to. Equity finance is the finance provided by real owners of the business, that is, ordinary shareholders. Quasi-equity is the finance provided by quasi-owners of the business, that is, preference shareholders. For the sake, quasi-owners are individuals or entities that have an interest in a business similar to that of owners, but without full ownership rights. Finally, debt finance is the finance provided by outsider, that is, creditors. Creditors are those individuals or firms who gives out loans. For example, let's use a scenario in Kenya where the government loans out funds known as Hustler Fund. In this case, the Kenyan government is the creditor. The next slide has a table showing the definition of the three terms. You can observe and understand them. Then I will continue with the second classification. Let's continue looking at ways in which a company raises its finance or funds. We started by looking at according to the company's relationship to the party giving the finance, and now the second classification is according to the duration, that is how long the finance will be in the business. Finances raised according to duration includes permanent finance, long-term finance, and short-term finance. Basing on this finances we have just mentioned, you can clearly have a hint on what they means. When we talk of permanent finance, we refers to long-term sources of funding that remain in a business for an extended period and are not meant to be repaid in the short run. These funds are used for financing fixed assets, long-term investments, and business expansion. Example of this finances are ordinary share capital, irredeemable preference share capital, and irredeemable debentures. Ordinary shares represents ownership in a company and entitles the shareholder to vote at general meetings and receive dividends. Preference shares are a type of company share that gives shareholders priority over common shareholders when it comes to dividends and asset distribution in case of liquidation. Irredeemable preference shares are types of preference shares that do not have a fixed maturity date and cannot be repurchased or redeemed by the issuing company. Debentures are a type of long-term debt instrument that companies issue to raise capital from investors. Wow, take a second to breath in and out. You can pause and have a couple of water. Thank you. Let's now look at long-term finance and short-term finance. Long-term finance refers to funds that a business raises and uses for more than 1 year, typically for capital-intensive projects, expansion, and strategic growth. They include equity capital, debentures and bonds, bank loans and term loans, and many more. Short-term finance refers to funds borrowed or raised for a short period, typically less than 1 year, to meet immediate business needs like working capital, inventory purchases, or emergency expenses. They include trade credit, bank overdraft, short-term loans, bill discounting, and more. For example, taking a loan from mobile apps is considered as a short-term finance. Now that you understand the terms, you can take a few seconds and look at the differences between long-term and short-term finance. I believe you have looked at the differences and maybe master them. Let's now look at our third classification of how companies raises funds, which is classified according to the origin of finance. Under this classification of originatity, only internal sources of finance lies underneath. Therefore, internal sources of finance are finances generated within the business, that is, from the business's own operations. Examples of such finances are retained earnings, provision for taxation, and adjustment in working capital items. In our next slide, we will look at the last classification of how finances are raised in the companies. Let's now have a look at our last classification of how companies raises funds, which is according to the rate of return that is in relation to the cost of that finance. Under this classification, finances bases on finance with variable rate of return and fixed rate of return capital. VRT refers to investments or financial instruments where the returns such as interest, capital gains, and more fluctuate over time based on market conditions, economic factors, or specific benchmarks, for example, stocks, mutual funds, bonds with floating interest rates, and real estate investments. WFR refers to capital that provides investors with a predetermined, stable return over a specific period, regardless of market fluctuations. Examples of WFR are bonds, fixed deposits, preferred shares, and debentures. Now we are going to look at sources of company finance. Sources of company finance is classified into two: short-term sources of finance and long-term sources of finance. In this lesson, we will only look at short-term sources of finance. Therefore, short-term sources of finance is finance due to be refunded to lenders after a short period. They include hire purchase, overdrafts, bill of exchange, and lessee financing. We will start by looking at hire purchase, which refers to an arrangement whereby a company acquires an asset by paying an initial installment, usually 40% of the cost of the asset, and repays the other part of the cost of the asset over a period of time. For example, a buyer, hirer, wants a motorcycle but cannot afford to pay the full price up front. A dealer, seller, offers the motorcycle under a hire purchase agreement. The motorcycle costs $3,000. Instead of paying the full amount, the buyer agrees to pay a down payment of $1,000, pay the remaining $2,000 in monthly installments of $200 for 10 months. The buyer uses the motorcycle while making payments, but the ownership remains with the dealer until the final payment is made. After the last payment, the buyer gains full ownership of the motorcycle. The second one is overdrafts. These are very short-term sources of finance to the company and are usually used to finance the company's working capital or solve its liquidity problems. This finance is usually not secure and is more costly than long-term loans, as much as interest is 1 to 2% higher than bank rates. Overdrafts is computed on a daily basis, although it may be paid monthly. For example, this image shows an example of an institution that offers overdrafts. Number 3 is bills of exchange. A bill of exchange is defined as an unconditional order in writing addressed by one person to another, signed by the person giving it, rewiring the person to whom it is addressed, to pay on demand at a fixed or determinable future date a certain sum of money to the order of the person or to bearer. For example, imagine John, a retailer, purchases goods worth $10,000 from Mark, a supplier, on credit. Since John does not have the money immediately, Mark issues a bill of exchange stating, John agrees to pay Mark $10,000 in 90 days. Key elements: drawer, Mark, the supplier who creates the bill; drawee, John, the buyer who accepts the bill and promises to pay; payee, Mark, or another party to whom payment is made; maturity, date, 90 days from the date of issue; amount, $10,000. If John accepts and signs the bill, it becomes a legally binding document. At maturity, John must pay Mark the agreed amount. If John cannot pay, Mark can take legal action or sell the bill to a bank at a discount, bill discounting. Our last example of short-term sources of company finance is lease financing. Earlier on, we had given an example of how lease occurs now. We will only define the term lease and then end our lesson. A lease is a contract whereby the owner of an asset, the leaser, grants to another party, the leasee, the executive right to use the asset in return for the payment of rent, i.e. lease payment. In other words, through leasing, a firm can obtain the use of certain fixed assets for which it must make a series of contractual periodic payments form the lease points of view. This lease payment is tax deducible. This marks the end of our lesson. I hope you have gained a lot of knowledge from this. Let's meet in our next, which will be on long-term sources of company finance. Stay safe. Take care.